well, welcome back. Back to Money in the Tankers. We've got Arnie back on deck from the recovery bay, off on sick leave last week, mate. I hope you put into HR for the sick leave for us.
Yeah. Put in.
And episode 41 today. So it was the big 4-0 last week, myself and Brad. And now Brad, he's a man down today. Brad's out of action.
Mate, we keep on trucking at Money in the Tank though. One of us falls and the other two keep going.
Next soldier up. So anyway, Joel, Seach, Principal Advisor, Hub LFG. Good to be with you all.
Yeah, and Arnie, Finance Professional. Yeah, good to be back.
Yeah, absolutely. So back on deck today. So we're going to do a nice short, sharp one for you guys today in terms of just the latest going on. So we've got a bit of up-to-date news to touch on. We've got Arnie going to touch on the Evergrande issues happening overseas, and then we've got the RBA rates again on the rise, what that means for equities, property, and the like. More current news items. So we've got a Rivkin quote, and we've got some 50/50s at the end as well. So let's hit it.
Yeah, I got a couple of Rivkin quotes here because we've misplaced the book, but I'll just give you some from Google.
The Bible. It's actually the Bible.
The Bible, the Money in the Tank Bible. Here's two, and we might have actually used these ones before, but here's one, which is, when you love others, you aren't nervous, which I don't mind. It's not really market specific. And then two more from Rivkin. I hate the weekends because there's no stock market. Yep. I'm sure we've all felt that way a little bit. Yep. And lastly, I love the market. It is my work, my play, and my life.
There you go. So
he was a keen investor, Rivkin. Obviously, sometimes we have a laugh about some of his more outspoken quotes, but which
the book's good for. So I'm going to make sure I find that Bible again, because I'm sure I packed it in my bag the other day. But and apologies for my mic today. I think I left my good Yeti mic at the office, so I believe it's there. So apologies for the mic situation. Hopefully, it still sounds clear enough for you guys.
Yeah, you sound good, Joel. It's all good.
Cool.
So today we thought we might touch on Evergrande Part 2, because I know you and I think potentially Brad as well, spoke about Evergrande last year in 2021 when it was in the news a lot, and people were worried about property developers in China, not just Evergrande, defaulting on their debt, and what that might mean for contagion risk in financial markets throughout the world, and also what it might mean for banking. Like if there were to be another potential crisis that could be triggered by that. So I said contagion in financial markets, but I meant contagion in all markets. And as was sort of seen at that point in time, I know you and I pointed out, Jolie, that miners in Australia like BHP and Rio, they took a big hit instantly in the market because there wasn't going to be as much supply being sent over to China from those miners who were providing the raw materials for the construction boom. And now it's back in the news because Evergrande and other big developers are sort of being hit by this 3 red line rule. And just to reiterate what the 3 red lines are, I've got them here just so I can refresh everyone's memory. It's an asset to liability ratio. It must be greater than 70%. Net debt to equity ratio must be less than 100%. And your cash to short-term borrowings ratio must be less than 1. So those were the rules put in place by the Chinese government to try and curtail the bubble in the property market in China. And I've done a little bit of research, and I'll try and give you guys a very brief summary. And I've actually done this research on YouTube, so you can go and get the full picture yourself. Brad actually sourced a lot of it, and one of the main channels I sort of learned a lot of this from was one called Lay's Real Talk, LEI''S, Lay's Real Talk. So interesting history on the Chinese model that they employ and how it sort of led to where we are now. So just in a nutshell, Jolie, I'll quickly go through this. Back in the 90s, there was a tax sharing reform, 1994, which made tax sharing between the local Chinese governments and the central government. And it basically meant that it was a bit of a mismatch because they shared revenues 50-50, but the local government had to shoulder the burden of the expenditures, more like 80% to 20. And that created one issue, which mainly meant that the central government was in surplus every year, but local governments were running a deficit. And they were also charging the local governments with the GDP growth for China, which is meant to sort of double every 20, 30 years. And then just to cap that off, to try and control it even more, the central government banned bond sales from local governments. So to get around this banning of bond sales, the local governments created this workaround, which was to create things that they call local government financing platforms. Basically what they do is they get a loan incapable institution, turn it into a company. The banks, the local banks, will give credit to those companies, which is kept off balance sheet. But there's an implicit government, like a local government guarantee of repayment. And then what they'll do is they'll use that, they will use land rights, they'll issue land rights to those new companies. And with those certificates, they will finance infrastructure projects and then pay the loans through concession revenue. So this has caused an interesting dynamic initially. And then when the 2008 crisis came about, the GFC, this sent borrowing into overdrive in China, and the central government announced 4 trillion in stimulus, but only 1.2 to be provided by them, 2.8 to be provided from the local government. So loans took off through these vehicles, these LGFPs. One of the main issues here is that these are short-term loans, 3 to 5 years, but infrastructure projects, if they return any money at all, it's normally an average of 7 to 10 years. So
it's around the time when they went on an absolute building frenzy there in Japan. I remember they were just building infrastructure just non-stop. It was huge. And I remember a fund manager talk once that they were building this infrastructure in these giant kind of cities, but there wasn't really the demand to have it there. They were just building for the sake of building for a while there, which is quite interesting.
That's continued all the way up until last year, mate, even until 2020 when the 3 red lines were put in. There's examples of cities building thousands and thousands of reservoirs, for example, along their rivers when not that many reservoirs are needed. So they're only just doing it just to fuel the construction boom. You don't need that many reservoirs.
Amazing, yeah.
Or even new cities, they're building massive new cities which are sort of uninhabited just to keep the construction boom going. So there's a lot of stuff like that. But in regard to in response to this crisis, or this local debt crisis that was created, Beijing ended up reversing their decision and let these local governments finance through bonds. But it was too late, as you can imagine. So now you've got sort of both of these issues playing out. And there's estimates by Goldman Sachs and others that it's around 52% of Chinese GDP is actually this hidden debt, this off balance sheet debt that the local governments have raised. So interesting. But then
for the tankers out there, if you Google some of China's cities that aren't inhabited or wasted infrastructure, and you'll probably find some pretty interesting stuff. I know I remember this fund manager saying they also replicated some overseas landmarks in these cities, the Statue of Liberty or whatever it may be, and they've done these random builds, and they're just there for no real particular reason apart from just replicated, and they've just been built.
It's pretty wild. And in one of these videos, there's footage of a Chinese economist who was American educated, Larry Lang. And he talks about how he compares Detroit's crisis when they went bankrupt and they were $18 billion in debt. And he provides some figures which sort of show that there's at least, I think he's around 30 approximately cities in China that are in as much debt. And he postulates that around 330 cities could be in as much debt. So he's saying that basically China might have 330 Detroits and nobody's really talking about it. Or maybe now they are, but they weren't back then. So
what's the Chinese government's stake in the main bank there? Have they got a bit of a stake in the actual main bank of China?
They definitely do. Everything's state-owned and controlled. I couldn't tell you what the stake is. Interestingly, another tidbit from this is that there's an interesting dynamic in China where there's no actual private land rights anymore. In the 70s, late 70s, they got rid of that. So if you want to own commercial or residential property in China, you actually just buy the right to use it off the government. And it's 40 years for commercial property. And then you have to pay, a fee to keep using it, and 70 years for residential. Again, if you want to maintain your house and still live there, if you're a family or whatever, you have to pay every 70 years to maintain the right to use that property. There's
another country like Singapore, I think, does something similar to that, where you don't ever own the land outright. It's a 99-year clause on there.
It's an interesting model. But so fast forward to today, Joel, we've got these 3 red line rules, and there's Evergrande, which is not the only property developer, but the main one in the headlines, who have stopped construction in 2021 on these projects, then resumed due to government intervention, but now stopped again. And there's reports that only 1/3 of these are completed. So it's 300 housing projects across 25 provinces have now decided to boycott their mortgage payments because construction isn't continuing on these projects. And it's affecting these large developers. And the Chinese, 7 of the major Chinese banks have come out and said, there's no issue, we've looked at it. And this has been supported by certain Western banks like Jefferies and Citi, who have backed it up, saying that the amounts at risk of default are not of note. However, independent estimates in some of these videos have said that there's 4.5 trillion yuan, or 665 billion USD, in non-performing loans, which is 12% of the total mortgage balance in China. And there's estimates of another 6 trillion yuan foreclosures across China. So that's over 1 trillion, or 28% exposure to the total Chinese mortgage balance, which is 9% of GDP. And that's getting worse year over year. So that's current, and then could be worse. So in a nutshell, that's the basic lay of the land of what's happening. And I guess what isn't known, which is what you and I can postulate on, is what are the outcomes of this? Is there going to be another 2008 style banking crisis if there's huge debt defaults in commercial and residential property? How exposed are other countries to this huge debt burden? I don't know, Joel, it's an interesting one.
Yeah, it's a great rundown, Arnie, and I was actually just getting a bit of information up on my phone here too. But you know, if they were already having issues, you know, what we broached this topic and we spoke about it probably 6 months ago now, and inflation issues have only intensified a little bit more, you know, since then. You know, it makes sense that potentially they're going to experience more and more dramas. So I think this won't be the last time we maybe speak about this topic, Arnie. What do you think?
No, I definitely think it's something to keep an eye on. And if we do see huge delinquencies in these mortgage repayments, and then these projects do not go ahead, it in turn means property developers like Evergrande will not be able to finance their own obligations and repay their debts. And then that will in turn affect any institution that's extended them credit, which we don't know how much exactly, but will include Western financiers. So I know a little while ago, maybe last year, Jay Powell said that he looked at Evergrande, the Evergrande crisis, and determined that American institutions weren't super exposed to it. But then again, you've got like things like any of the raw materials provided by Australia, steel, for example, or other countries, which is not going to be flowing in these great amounts to China. So yeah, I think it's one to keep an eye on. Obviously, we don't want to see a huge financial crash like we saw in 2008. It's bad for everyone, especially in the difficult times that we're already in. It would just be like black swan on black swan on black swan, with a pandemic and then a war and now potentially this. So one to keep an eye on, Jolie. But I don't know what the outcome is. Maybe we can ask Brad to sort of expand upon that when he gets back. But it's something to keep an eye on.
Yeah, absolutely. So we'll definitely keep you guys posted in terms of where that goes to. And we're going to update, I guess, and thanks for the rundown on that, Evergrande, Arnie. We're going to run down, I guess, on just the latest things coming out from the markets and also the RBA rates as well. So we spoke last week that with Brad that the Fed in America has raised their rate by 75 basis points, and then the RBA came out on Tuesday, so the first Tuesday of each month in Australia here, and they've raised their rate by 50 basis points. So it's now up at a 1.85%. So essentially it's been pushed up. I think there was a thought pattern that most economists, and we've spoken about economists, you know, just flying with the wind as to what they think is going to happen. And most economists, you know, thought a 50 basis point rise was going to be the case. I think there's a decent weighting to say maybe it was going to be a 40 basis point rise, but essentially, they've moved it higher, and they've placed a high priority there on returning the inflation rate to the 2 to 3% range over time, whilst keeping the economy on an even keel, from the notes from the RBA Governor Philip Lowe. So the path to achieve the balance is a narrow one and clouded with uncertainty, they say. So not least because of global developments, which we've spoken about as well. So the outlook for global economic growth has been downgraded due to pressures on real incomes from higher inflation and the tightening of monetary policy in most countries. That means raising the interest rate in most countries, Russia's invasion of Ukraine, and the COVID containment measures in China. So inflation essentially is, you know, it's front of mind. I did read an article suggesting the other day from Philip Lowe coming out saying they haven't set the agenda for the rest of the year by doing 50 every single month. They're going to do it as a case-by-case basis, month on month, and see how those implementations of tightening of the monetary policy then flows through to the real GDP and the inflation numbers, essentially.
There was some news that came out from Bullard, who's a member of the Fed, and he was saying that he wants to see their interest rates up around high 3s to 4%. I don't know if he said by the end of this year, maybe by the end of next year, but I think it was by the end of this year. And that would be another 150 basis points. So with the next, there's 3 more meetings till the end of the year.
Yep.
So you could hypothesize that they're going to raise rates by 75, 50, and 25 at each meeting, or maybe they'll do 50, 50, 50.
Yep.
But I would suspect they'll probably front end it and put the higher one next to try and increase the demand destruction that they're seeking to try and fix the inflation problems. So
I'll probably go against you on that one, because I reckon they were tinkering with the idea of maybe being a little bit lighter in this one. So potentially, I reckon next one will be maybe a 50. I don't know whether they'll go to the 75. I think they want to sort of see the 50s, how they get pushed into the economy and how that impacts. So I don't reckon they'll get as high as a 75. I reckon the Fed's probably got another one in it. But yeah, I just think.
I'm talking about the Fed, not the Reserve Bank of Australia. Sorry. So I think the American Fed will. I think it's likely they'll do 75, 50, 25. Gotcha. With regard to our Reserve Bank of Australia, I agree with you, Jolie. I think they'll do 50, see how it plays out, and then monitor the situation. So.
Yeah. So,
but I do think we've got another 3 rate. Like, I think every time America rises, I think our Reserve Bank will follow suit, because they have to, as we've talked about. So.
Yep. So let's just keep an eye out for that. So essentially, inflation is expected to peak later this year, which they have forecast at maybe around the 7.75%, and then hopefully they're suggesting that it's a little above 4% over 23, and then back around the 3% mark in 2024. So it's a long time away for it to get back, but that's what they talk about, that short-term pain of inflation to have the long-term gain, because they don't want it to get out of hand.
Spot on, mate. So I guess we'll watch that space.
Definitely watch that space. I guess some of the other interesting ones that have come with that is all the media and all the hype up about markets and all the hype up about stock markets and property as well. So as we spoke about last week with Brad, the stock market is very forward reactionary. The first 6 months of the year has been a bad time in the stock market, because investors and institutions and hedge fund managers and your day traders less so, but they can sort of see the writing on the wall as to what's transpiring, and they'll sell down on anticipation of these things coming to fruition, and they're almost like forward-thinking, predictive in terms of what they're essentially seeing. And then you'll start to see rises occur once they start to see the dark skies disappearing, the grey clouds starting to come out, and the sky starting to open up a little bit. They'll be forward reactionary. So sometimes by the time you make a change in something, you're a bit too late, because the market's already forward factored that in by 6 months.
That's right, mate. And I guess who knows what's going to happen? Like, as we just sort of mentioned, if there is a huge crash because of contagion risk out of China, well, that's going to be very deflationary. So we'll see what happens in that space. But
the other one I was going to mention, Arnie, while I'm just on the market, was just an interesting bit of data that sort of come across the desk, is just in terms of Australia historically in the housing market, how that's gone in higher interest rate environments or higher inflationary environments. So I thought the listeners might be interested to know a little bit about that. So Australia's experienced 4 recessions over the past 50 years. Evidence confirms that at least 2 out of the 8 capital cities, plus oodles or a lot of regional locations, produced double-digit house price growth during each of Australia's recession years, which is an interesting tidbit there. So a technical recession, is 2 negative quarters of GDP consecutive. And there's a difference between the broader national economy producing negative growth in 2 consecutive quarters, so which I mentioned then. So the other one was I was just going to mention as well was So the article suggests here, contrary to the age-old suggestion that house prices can't keep rising without wages growing just as much, the evidence potentially suggests otherwise as well. So over the past 5 decades, the nation's median house price tripled in the 70s, increased by 158% in the 80s, 72% in the 90s, 146% in the 2000s, and the leanest decade was the 10 years ending to 2020, 48% growth, while house prices already increased by 43% during the first 2.5 years of the current decade. So it's interesting that, inflation, things will still grow even if inflation is higher. And then one of the biggest myths in property markets is that real estate values can't increase when interest rates are rising. So the history books will show multiple areas when it's occurred. So the national house price tripled in the 70s at a time when the standard variable home loan went from 6.5% to 10%, and home loan rates consistently increased through the 80s from 10 to 16.8. So maybe, I was probably too young for them, and some of the listeners will be too young, but interest rates did get that high. But house prices more than doubled in that decade. And the most recent era, when the house prices again doubled in just 6 years to 2008, home loan rates increased from 6.3 to 9.5. Now, it's not necessarily that we'll get back to those higher interest rates, because we're just in a different environment now than we were, many, many years ago. But it just sort of shows that markets can actually still do fine, even when inflation is potentially high or interest rates are going up.
Yeah, it's a really good point. And yeah, with just caveat there, as Jolly sort of mentioned at the end, when you've got home prices going in the 70s from 20 grand or 10 grand to 20 grand to 20 grand to 40 grand, and then the 90s maybe 40 to 80 to 160, it's a lot easier for those huge percentage moves that Jolly was talking about. But then I was surprised by some of the percentage gains you were saying, Jolly, in the early 2000s, and then even 48% 2010, because as we know, house prices everywhere, especially in the major East Coast cities, are very large. So to see large increases like that still is massive. But I do, even though that it's interesting data you've pointed out, and that has been a trend, I do think that house prices will come down because of the rising cost of living and the rising cost of mortgage repayments at the moment. So
we'll see where it all goes. Yeah. So,
interesting.
And a couple of the major cities like Melbourne and Sydney have started to come off a little bit already. So
I got some rapid fire news if you want.
Yeah, far away. Let's do it.
I'm going to start with the top of the one, which is that Tesla has their annual. They got their annual general meeting. I think it's tonight or today in America's time, and they're going to be discussing all things Tesla, but also the fact that they're going to be doing a stock split that has been reported pretty widely. Here's a few other ones. So we've got China set to begin effective Taiwan blockade hours after Pelosi concludes visit. There's a live fire drill encircling the island will block flights and shipping. So they're set to begin this effective blockade, which is crazy to me. Have you been following this Pelosi news with her tour of Asia?
So I saw it come across the desk this morning from our market update, and they were threatening and they weren't happy with her visiting Taiwan. But I didn't hear about the blockade. So the blockade is to do with the shipping containers, Arnie?
Air and shipping.
Air and shipping,
so I think maybe they're trying to keep her in Taiwan because she's concluded the visit.
Yeah, interesting.
Well, I don't know what they're trying to do. There's been a Russian strike force apparently taking aim at Zelensky's hometown. So that's just some news from what's happening in the war there. Back with Nancy Pelosi, her husband, Paul, has pled not guilty over his driving under the influence crash. So he's the one who's been accused of trading off insider information, because I don't know if you've kept up with the CHIPS Act, but the CHIPS Act in America was passed to do with semiconductor production in America. And there was speculation that Paul Pelosi, Nancy's husband, has been buying calls in certain chip makers like NVIDIA ahead of that act being confirmed or announced that it was going ahead, which will result in massive spending in that market for those companies. So that's an interesting one. And that's about all I've got at the moment, Joel. I will mention one bit of crypto news that Solana and USDC, there's been a hacking scandal where private wallets have been drained, and it's been phantom wallets that have been like 6 months dormant. So just carrying the torch while Brad's away. I'm not super across this news, but
I'll be very proud of you, mate.
It's a little bit worrying to hear that, there's like these private wallets that have been hacked, and it sounds like it's Solana specific. So I don't know what the cause is. We can ask Brad what the cause is.
Might have to get Brad to do some investigation in for next week's pod, and that'll tell us whether he listens to this pod in full. So Brad, if you're listening, we expect a full rundown on that, mate.
Anyway, that's it, man. So we've had relatively quick one this week, but you got a 50-50 for us?
Yeah, I guess. And the last one was just really quickly is the market update today was the rebound in July. So the market's rebounded pretty well the past few weeks now, and it's sort of saying investors have shaken off worries that the US had potentially already fallen into recession. So it sort of sent traders back to some of the beaten down stocks. So just talking a bit about that before, interestingly enough, that the markets are sort of reacting, fairly quickly at the moment in terms of how things are shaping up. And, we've seen the Australian market pick up the last few weeks and have its best month. And then the Australian market as well has also picked up too. So, just keep an eye on how things track over the coming weeks. And I'm sure there'll be more to come from the market movements as well. But that's just a bit of a market update for you guys also today.
Cheers, Joey.
So, in terms of the 50-50 this week, Arnie. So, and where can listeners get at us if they've got a good 50-50 they want to touch on, or they want to vote on, and also get us on question and answers as well.
Yeah, get us on the socials for Q&A or any 50-50. So it's at Money in the Tank, YouTube, Instagram, Facebook, and Twitter. We are not active on any of them because that's my fault, but we'll have to get more active on them. Facebook's the best one to get us on, or YouTube comments.
Yep, absolutely. So hit us up. Any questions you want us to touch on, more than happy to chat about, or any topics you want to touch on too. So appreciate all the listeners' feedback. It's always great. In terms of 50-50 this week, so it's for my own personal experience at the moment. I've just bought some AirPods that I've been loving using the past couple of months now. So Apple, feel free if you want to throw some sponsorship at the Money in the Tank podcast, you can feel free to. But the question is, do you prefer the AirPods or the big kind of Dre beat type setups when walking or going to the gym or whatever you're doing? What do you prefer?
I always have over the ear like headphones, not this big, but I like those because I feel like they're more secure if I'm walking or going to the gym or anything like that. Because the in-ear non-connected ones, which I have used, I just feel like they're always going to fall out, or they just don't feel secure. Maybe it's my ear. Maybe it's my ear hole. It's a weird shape. I don't know.
Possibly, yeah, possibly. I did the tips they come with aren't that nice. I've got some foam ones that are a bit softer on the ears. And I used to love the Dre beats, but I don't know if it's a new thing or whatnot. But I've really enjoyed the AirPods lately, so I'm gonna go with the pods.
Do you like being unencumbered? Because that is one thing that when you're doing something, it does feel, and if you start to sweat or whatever, it can feel yuck. So I can imagine that the pods would be better in that sense.
Definitely, definitely, and a bit of fresh air as well going into your face and your ears. Sometimes you get a bit hot at the gym or whenever you're working out, so I like that too. But yes, I must admit, they are potentially very losable. I got off the train last night because I had a training thing in the city, and I was wearing a mask on the train as you do, and I took it off as I got out of the train station, and it just flicks my pod. One of the buds comes out and literally almost falls down the gap in the staircase. I wouldn't have been able to get it, so it would have been done.
No, I wonder how much money do you reckon Apple makes on just replacing like one single pod each time? There must be like a pod replace. I'm gonna look into that.
They love it. So anyway, but and I think there's an app you can get to help you when you lose them. So it's inevitable. I will lose them. Don't know how long it'll take. It's been a couple of months now, so I'm having a good run. But
keep us updated.
So hit us up, listeners. Any good 50-50s you got, or what do you prefer more? We always enjoy the questions, and we'll look forward to come back to you guys next week as well. So keep hitting us up and keep firing those questions away. We love it.
That's a great 50-50, Jolie. Love it. All right. Cheers, everyone.
Thanks, guys. Cheers, tankers.
Bye.